Welcome back to Indianomics. This is our credit policy curtain raiser. We have been speaking with Chetan Ahya, Managing Director and Chief Economist at Morgan Stanley, Prasanna, the Chief Economist at ICICI Securities PD, and joining us now is also the State Bank of India Managing Director, Mr. V.G. Kannan. Well, Mr. Kannan, our poll indicated that there is nothing coming in the credit policy by way of a rate action. What are your expectations?
Status quo regarding the rates, though I still feel there is a scope for them to reduce the rates, but this time round I would say that they would like to look at the what is going to be the Fed action, and once the Fed action goes through on the first this month end, next month, sorry, and then they will probably take a call as to what we do. I expect that before March we expect a cut.
Mr. Kannan, if the credit policy indeed does not announce anything by way of rate action, even then, do you think banks have the scope to cut deposit rates and lending rates, deposit rates or base rates?
My own reading of the deposit is that deposits have been growing, but not to the extent it was growing in the past when the rates were high. Therefore, going forward, immediately cutting the rates would actually hurt us in the form of flows by way of deposits, and unless the Government of India is prodded into reducing the rates on the post office deposits and other schemes, and the chances of further cutting could be quite suicidal to all the banks. I feel that if there is a move there also, even without a Reserve Bank of India cut, there could be a possibility of a deposit cut and rate cut in advances. But without that, I think as of now, there may not be much of a scope.
In that case, a final question to you. What kind of a loan growth are you expecting in the second half of FY16?
The end of the year, I think we are looking at around 12 to 13.5, 14%. So, having been around 10%, I think we expect the growth in the next 4 months to be around 14 to 15%. Mostly by way of retail, as also by way of takeover for advances.
Okay, let me toss this to Prasanna. Prasanna, the answer from the bankers doesn't seem to be that they are expecting too much by way of deposit cuts or lending rate cuts. Therefore, what is your sense on economic growth itself? We should not be factoring in interest rates as an input into expecting better demand at all in FY16, in 2016?
So obviously there have been some cuts already, right? There have been some lending rate cuts, so you would expect the lagged effect to kind of flow through into next year. So definitely that should be part of any growth estimate. Also, I think this is a busy season, right? So liquidity has definitely tightened. So therefore, I think there shouldn't be any immediate expectation. But remember also, I think there is a request by the banks for the government to look into small savings rates. And suppose the government does something on that, say in the run up to the budget or in the budget, then maybe that could be a trigger for some rate cuts, for lending rate cuts. So then that would mean that going into FY17, I think definitely there is more in the pipeline in terms of lower interest rates.
What therefore are you looking at in terms of economic growth next year? Is there an economic upturn that you're penciling in 2016 or in FY17, Prasanna?
Yeah, so that's right. In terms of GVA, our estimate for FY16 is 7 to 7.5%. It's actually 7.3% in the middle of that range. And into FY17, our estimate is 7.5 to 8% at this point of time. Now, of course, the pay commission, what you're talking about, that stimulus, it matters only if the government allows the deficit to expand. But otherwise, if they're sticking to 3.5%, it essentially means that they're paying out higher salaries, but somewhere else they're trimming either the spending or they're taking out more resources from the private sector, right? So then in that case, maybe it's not much of a stimulus.
How are you looking at the cost of money in the economy? Are you expecting a seminal fall in interest rate?
Yeah, I think, Latha, we should get more lending rate cuts. As you know, there's a challenge that the deposit structure is such that you have the liability period of about 1 year. So the transmission of that just by very nature gets delayed, and we have not got enough of that deposit rate cuts that banks have done transmitted through to the lending rates. Yes, they have to fund their credit costs because NPLs have been high, but if you take like a 6 to 9 month outlook, we should see at least another 50 basis points cut in the lending rates as banks begin to pass more and more of these deposit cuts into the lending rates.
So what are you expecting by way of growth in FY17?
I think I will give you both the delta as well as the number. So the delta for financial year 16 will be 30 basis points, and we are looking at 7.5%. Sorry, 20 basis points, and we're looking at 7.5%. And March 17, we are at 8.1%.
That's a very positive number. But let me end with just one last question on what else you may expect from the credit policy. Mr. Kannan, you go first. What other than the interest rates will you expect from the policy?
Other than the rate cut, I don't see much of a change. There could be some discussions on the liquidity coverage ratio, because the banks have been making reference to the Reserve Bank of India, saying having SLR, CRR and a liquidity coverage ratio is a double whammy. So we do expect that there could be some relaxation there.
Final word from you, Prasanna. What will this credit policy be important for you?
So essentially, I think it will be interesting to see whether RBI, is there any change in view in terms of the balance sheet growth, because the kind of BOP surplus one was expecting at the beginning of the year hasn't materialized clearly, and going into next year also, again, the outlook is uncertain. So in that case, I mean, is there a change in the kind of balance sheet growth which the RBI has estimated, and therefore does it lead to any change in their open market operations?
Chetan, what will you look forward to on December 1st?
Well, mine might be a bit more from what I would be wanting to see personally rather than what I would expect, is that I think that they should probably raise the issue of recapitalization of public sector banks.
Okay.
RBI has not been so aggressive mentioning that this is an issue, but soon it will become an issue if we're going to get growth recovery. So the government has been delaying that decision for too long, and I would wish that RBI raises it in the monetary policy.
All right, gentlemen, thank you very much for joining me in this edition of Indianomics. Key takeaways for the next 2-3 days before the credit policy is announced. One, Reserve Bank not expected to do anything much. Actually, Reserve Bank not even expected to say anything different from the September 30th policy, when they said that they still remain in accommodation mode. Our experts think that that will not change. But my bet is that we will have to look for nuances of possible hawkishness, because the past two inflation readings have been a little higher than the Reserve Bank's trajectory. And three, as Chetan pointed out, people will watch out very seriously for whether they say anything about the banking sector and the recapitalization of banks, which is still pretty inadequate compared to the NPL load. And finally, what do they have to say about the rupee? Prasanna spoke about the size of the balance sheet. Basically, that means will they be buying bonds or selling bonds? How will they treat the rupee depreciation? That or lack of rupee depreciation will be an important point that will be watched for. That's it on this edition of Indianomics. Thanks for watching.